Most often you hear that you only need 3.5% to buy a house, or 10%, or that you must put 20% down payment. So in this video, I'm going to break down these three options and cover pros and cons for each. I'll do it in the context of living in an expensive area where an average home price is about $1 million, affordable area where you can buy a home for about $300,000, and neighborhoods in between where a median home price is about $600,000. When analyzing these options, we'll look at the cost of entry, the long-term perspective, and flexibility during the negotiation process. And at the end, I'll share a tip on how to get you the best mortgage rate possible. If you're enjoying my videos but haven't subscribed yet, please click the button and give this video a thumbs up. This helps my videos reach a wider audience, spreading financial literacy, and helps me make more free content for you guys. Let's get right into it. First is a down payment option at 3.5%. This is definitely the most affordable option, and if that's all you have to put down on a house, you can qualify for an FHA loan with a low credit score of 580. FHA loan is a government-backed loan, so that if you default on your payments, the government will pay back your loan. If your credit score is below 580, there's some flexibility to still get approved by increasing your down payment to 10%. There are definitely some downsides to this loan. At 3.5%, you're looking to finance 96.5% of your home price. The higher the amount you're financing, the more you'll pay in interest, which means the higher your monthly payment will be. With the FHA loan, you're also looking at permanent private mortgage insurance. Unlike conventional loans, where once you reach 20% equity, you can cancel the PMI, PMI on FHA loans will stay with you for the duration of your loan, keeping that monthly payment high. FHA loans come with a borrowing limit and property and inspection requirements that need to be met in order to qualify for the loan. This gives you much less flexibility during the buying and negotiation process because it may not be appealing to sellers in a situation with multiple offers, higher down payments, and better financing options. To finance a $1 million property with 3.5% down, you'd be financing $965,000, which will result in a monthly payment close to $8,000 after working in PMI, property taxes, and homeowners insurance. That's really high. Not to mention, a $1 million property will likely not qualify for an FHA loan. If you live in an expensive area, I recommend setting a goal of getting a credit score of 720 and saving up to put a decent down payment on a home while renting a more affordable unit. For a medium-priced home, you're looking at a down payment of about $20,000. And if you live in an affordable area, you'll need about $10,000–$15,000 to qualify for an FHA loan. If we're looking across the three categories, cost of entry is low, which makes it affordable, so we'll color it green. But long-term perspective, monthly payment will be very high, so this will be red, and using an FHA loan bounds you to many requirements, which leaves you with little flexibility, so that will be red as well. Now let's look at an option of putting 10% down on your property. This qualifies you for a conventional loan if you have a decent credit score. You can get the best rate if your credit score is above 720. The cost of entry is getting higher, but still achievable with some advanced planning. Putting down 10% means you're financing 90% of your property, which brings down the interest and will result in a lower monthly payment. With a conventional loan, you have an option to cancel your PMI once you reach 20% equity, which will help keep the monthly payment lower. You also have many loan options, which in combination with good credit score and a higher down payment can make it very attractive to the seller. Another advantage of a conventional loan is that you are not required to complete a home inspection and can use that flexibility to waive these inspections in your offer. You can and should still complete all the inspections even if they're waived in your offer so that you know the state of the property you're buying and are making informed decisions. A conventional loan may offer another advantage of closing early, which may also be appealing to the seller. Now let's look at how much money you need. These numbers are a bit higher, but definitely achievable with some planning ahead. Saving up for a 10% down payment is a much smarter financial decision than financing a higher amount, and I'll show you why. Check out this math. For every $10,000 financed over 30 years at 7% interest rate, you would pay almost $14,000 in interest over the life of the loan. For every $50,000 financed with the same terms, you'll be paying $69,000 in interest over the course of the loan. So over 30 years, each $10,000 turns into almost $24,000, and each $50,000 turns into almost $120,000. This is crazy, and this is proof that in this case, saving is definitely better than financing. So set a goal of how much you need for a down payment based on your area's median home prices. Set a timeline of about 2 to 6 years and work towards saving it up. Now, going back to our categories, a 10% down payment option, cost of entry is higher, so I covered it in yellow. Your payment will stay reasonable and will be reduced once you reach 20%, so it's green from the long-term perspective and gives you good flexibility during the negotiation process, so we'll make it green. Now let's look at a 20% down payment scenario. With 20%, you get all the benefits of the 10% down payment plus even lower monthly payment because you're only financing 80% of your home price. And you're not going to be paying PMI since you're coming in at 20% equity. Your offer is very strong and you can still use the flexibility to waive inspections if you'd like in a highly competitive market. It's still strongly advisable to complete all the inspections even if you waive them in your offer to make sure that you're fully aware of the condition of your property. Putting down 20%, however, may mean that you're fully depleting your savings, putting you in a vulnerable position after purchasing the house. In addition to your down payment, you'll need to account for costs like home inspections during the buying process, covering prorated property taxes if your home's assessed value has increased from what the seller previously paid. You may also need some money to adjust things in the house, fix if anything is broken, buy new furniture, cover moving costs, etc. So if we're rating our 20% down payment option along our 3 measures, I'll give it a red for cost of entry, green with caution for long-term perspective to remind you that you need to have money set aside for the unforeseen costs that are separate from your emergency fund, and green for flexibility. And here are our numbers for the 3 property price tiers. Again, they seem steep, but remember that it costs more in interest to borrow than the amount you're borrowing. Last but not least, the 2 most important people in your home buying process are your agent. Their job is to help you get the home you want, negotiate the best offer, and help you through the process, and your mortgage broker, whose job it is to get you the lowest rate possible and successfully get the loan on time. And here's the tip I promised. Don't go with the first person you meet or the first referral you get, especially when it comes to mortgage brokers. Interview at least 3 to find what rates they offer and how much it costs. These can vary significantly, and even saving 1 or 2 percentage points can add up to thousands of dollars in savings over the life of your loan. Thanks you guys for watching. I'll see you in the next video.